All right. 4:15 on a Saturday. Saturday. There you go. Start over, right? 4:15 on a Friday. It's been one of those weeks that it feels like it's been a whole extra day.
That's it. Yeah.
You can tell by me not knowing what day is and Ben's beard that it's been a little turbulent in the market this week, eh, Ben?
This year.
This year.
Yeah.
I know this year, but no worse than probably this week. And maybe today. Is today the worst day of the year so far?
Today's not the worst day of the year so far, but certainly damage is being done in the markets over the first little while here. Just looking to see where the indices close down, but yeah, we got NASDAQ and Russell both showing some pretty decent drawdowns.
Yeah. So now what's that face? A little silly here today already. Okay, so what with all that stuff going on, what's your headspace like right now as far as the portfolios are concerned and what you're looking at doing, or are you just holding on to what's around?
Yeah, I think I think the last couple of weeks as we talk into this, I've been talking for kind of a few months about expecting a bit of a slowdown in 22. And so as we kind of led into the end of the year, things were pretty calm in the markets and it looked like we'd probably get a decent start to the year. So, as I tried to reduce risk into year end and did a little bit in the first couple of weeks of January as we started to get signals that this kind of slowdown was going to come quicker than we expected. I kind of describe it as not quite being where I want to be today, given what's transpired this past 5 days. So, we had some glimpses of some positives. On Wednesday this week, we had gold and miners starting to show some signs of strength, and they've hung in there, and utilities and consumer staples hung in pretty good. And then, we've kind of had a one directional move out of the gate here with, as I just look here, NASDAQ's down, looks like about 12% year to date. Russell's down about 12% year to date as well. So a couple of weeks ago when I had those signals, we tried to exit NASDAQ and XLK and Russell small cap, added to bonds, IEF, TLT, EDV. So this week from a what I did perspective, the only thing that I did was add to EDV, which is long duration bonds. We had a really crummy close into the end of the day here. Lots of pressure on those big names, and so to answer your question, what am I doing? I'm really looking and saying, like, is this, when we get any of these types of corrections, and I've studied history enough in the markets, but also lived through a couple of them. It's every time you go, is this what it was like in 2000? Or is this what it was like in 2001? Or is this what it was like in 2011 or 8 or 15 or 18? So you try to draw some similarities through when we get a correction phase like that. So that's what I did most of this week is, what are some of these similarities and what are likely outcomes from them?
So would you say we're securely in a quad 4 right now?
So we've had 3 kind of quad 4 weeks where we've had that kind of those assets trading well. And so, what's interesting is the data doesn't support that right now, more of a kind of a narrow quad 4. So that's kind of leaned me towards, instead of panicking out of stocks and selling equities right away, it's leaned me towards, we still have the S&P 500, we still have some of these positions in portfolios, so it's kind of leaned me towards staying with those because those markets are super heavily oversold right now. Jared Dillian, who's a newsletter guy that I follow, kind of put it best. Kind of going into this weekend, you don't want to be short, you don't want to be long. You kind of just want to stay with what you have and be patient and wait for it. And so I'd say yes. The answer is we've had 3 quad 4 weeks here to start January.
Okay.
Yeah.
As always, if anybody has questions, definitely put them down in the question bar down at the bottom or at the little bubble there. Type it in or raise your hand and we will take your questions. All right, you got any Ben's charts for us or what?
Definitely have charts to go through. You know, let's go into that, and then we can talk about some individual names and just kind of some of the damage that's happening to those stocks that
Sure.
some of those high flyers. We don't own them, but some of those high flyers that
Sure.
you know, have really come under pressure here.
Oh yeah, there's lots to talk about in that regard.
Yeah. All right.
Couple shockers for sure.
Definitely. Okay, so this was interesting chart put out by Julian Brigden, who's Raoul's partner, and this was kind of a longer term. Try to pull it back and take a look at, you know, what the potential risks are, and you know, how different indices have done over the last kind of 10 years. We'll say this is 2011 to 2021, and I guess the start of 22, just to give you a sense. But you know, these are all the different tickers. If we look at XLK on the top, which is technology, and XME, which is mining on the bottom. So energy and mining obviously be negative over 10-year cycle, where tech has been the big outperformer, as well as XLV, which should be primarily driven by Amazon, and then the home builders and consumer discretionary. So this is a zoom back. And so as we look at, and I mentioned kind of tech, NASDAQ being down almost 12% out of the gate here, and probably worse if you look at the November highs. And those November highs are interesting, which we'll talk about in a second. But this is XLK. And so as we look at it, I say, you know, there's a real chance there could be a reasonable significant sell-off in kind of tech and tech growthy names. And so when you look at that, it's much more reminiscent of kind of 2000, where we had a kind of a tech-led sell-off. I don't think we're in that environment just yet, but it's a lot more like that. And there's a bigger risk to the tech sector, like the Googles, the Netflix, Amazons, the Nvidias, Facebooks. So there's some risk with those names right now. But to zoom back to look and say, you know, as we potentially look to kind of converge in some of these areas, the defensive names should pick up here, or the more aggressive high growth names look like they've come under pressure to start the year. That's a first one. So let me know when you get the next one up there. Yep. So, you know, we kind of bookend it with sentiment. And so, you know, you look at it and you say, okay, well, is this typically what happens as rates start to rise? The economy is going through this transition, Fed tightening. You know, we also have to take a look at what the sentiment's like. And so, you know, as I look at the NASDAQ today, we've had massive oversold signals on it for a couple of days here. And if we look at this gives you a signal for how kind of bearish the general tone is, and that tends to be an inverse correlation to what actually happens after that. And so tone and sentiment is quite negative. So I don't think there's anything you do except for pay attention to this. And it's important in certain things that we own, because crypto would certainly play a part within this. And so heavily oversold signals, really negative sentiment, these tend to be positives after the fact, or we tend to get a rally unless we get something over the weekend that we can't expect, where, you know, massive hedge fund blows up, or there's a run on a bank or something like that. Barring any of that, which I don't think happens, there's a high probability that we see a reasonable rally in the last week of the month.
Okay, great.
And so a lot of this has to do, kind of this market disruption has a lot to do with what the Fed's been doing. And so this is an interesting graphic to look at, you know, what the central banks have been doing. This is primarily driven around the Fed, and all of this started in 2008 after the 2008 crisis. And so I have and continue to have lots of questions around is this like 2008? And so it's a lot different than 2008. I mean, 2008 was driven kind of primarily by a massive leverage in the housing sector, derivative on top of derivative, that wasn't sustainable. It became a systemic financial risk. And so that's very different than what we see today. But the central bank started to expand the balance sheet there. This is taper tantrum where Bernanke tried to aggressively taper. The market didn't like it. He changed his opinion. And we wanted to stimulate here. They grew again. And coming into 2018, they were raising rates, quantitative tightening, market dropped a lot. Powell came back and changed his tune, started cutting rates again and more quantitative easing, and markets recovered from there. And then we've seen kind of the this last move up until the top of November. And so November, first week in November, the Fed said they're going to start reducing their balance sheet. That was when the NASDAQ, small cap, crypto, all topped that week. So, you know, as we have questions about what is the central bank going to do now, I mean, this is a visual aid to look at that, and certainly I'll give my thoughts on that as we summarize.
Great.
Okay, one more. That's it. It's the last
Four,
one.
okay.
Yeah. Try to leave it with crypto because we have lots of questions about it still, and we have had a pretty material amount of selling in the space over the past 6 weeks. And so this is just a chart on Ethereum. And so, we got a pretty big mismatch between what's happening kind of in the NFT space, which is backed by mostly Ethereum. And so you got kind of these NFTs staying at huge, insane valuations. If you look at OpenSea, I think they did 4.3 billion in transactions last month. And so you got this elevated NFT exchange level, yet Ethereum's falling down below, kind of supporting it. So, from a technical perspective, these are pretty interesting levels, and nothing I think we need to run away from right now. I think we actually, if tech bounces, I think crypto bounces more, and certainly something I'm paying close attention to from a long-term perspective.
Gotcha.
Good.
Yeah, very good.
Okay.
Wow, a lot to unpack there. Or I guess we kind of already did. But yeah, I mean, so what's doing well then in this environment? I mean, it kind of goes back to the quad 4 that you mentioned, but just kind of mentioned, if you watch the news or you turn on CNBC or something like that, it just seems like everything's going down. But what does well in this type of environment?
Yeah, so typically what gets you paid in this kind of environment is bonds, US dollars, bonds, gold, and bonds had a pretty good week, best week they've had in a little while here. So in that environment, they would tend to be the things that protect you. And so when we look at where they're trading, though, they're kind of in the middle of their range here, where stocks are pretty heavily oversold right now. So bonds would tend to be what protect you through this. Additionally, which we bought and I've talked about a little bit, is we have some money in yen and Swiss franc. I think Swiss franc was up about 1% or so versus US dollar today. So those are things that protect you in this kind of time of uncertainty.
Gotcha. So you mentioned there were some big names you wanted to talk about here that took a bit of a tumble today. Which one do you want to start with? Netflix?
Well, I mean, Netflix was probably the big, I'd say, like, big company that came under pressure today. I think they were down, when I looked at it, they were down about 25%. Looks like they closed the day down 22%. So they finished down $110 a share. Yeah, I mean, Netflix I think they realize that these other streaming services are coming on quite aggressively, and they seem to concede on their call last night that Roku and Crave and Disney Plus are really stealing their subscriber base. So that's a lot of pressure on one of the big high growth names.
Mhm. It's kind of surprising they're losing market share, because I don't know about you and your house, but it's not, one or the other. It's, I think people have subscribed to a lot of different streaming services, right? So it's surprising losing that much market share, but the numbers are the numbers, I guess.
Yeah, it's a bit surprising too, but maybe it's getting a bit diluted now. I'm not sure,
Hmm.
but
Hmm.
yeah, it is a bit surprising because yeah, we subscribe to them all as well, and a lot of them get
Yeah,
bundled into other things that you have.
for sure, for
Yeah,
sure.
yeah.
Okay, what are some of the other ones that you took notice of?
Well, certainly in Canada, Shopify touched
Yeah.
50 to 52-week low today. It's cut in half from the November highs, so it's down
Hmm.
50% from the November highs. So, um, interesting. Obviously, we don't have exposure to Shopify, but that's a huge sell-off in the Canadian markets. They've fallen down the list quite dramatically. And if you look at it, I mean, presently still trading at 150 times earnings. So, good company. Obviously, a nice story to see it grow, but you see how quickly some of these things can come under pressure. That's a good example of a high growth company that was bought mostly as the index was being bought in
Hmm.
Canada, and that's quickly reversed in the last 3 months here.
Yeah, for sure. Anything, any other ones you want to mention?
Those are the two big names, and one of the things we've talked about over the last couple of weeks, right, is that we've had this massive concentration driving the markets, where it's Facebook, Apple, Netflix, Google, Amazon, and as we look at how those have done these past couple of weeks, the only one that's sustained and kind of held up has been Apple. It stayed in a reasonably recent trend and change, where the other ones are coming under pressure. So it'll be interesting to see how we go through here. But I think we've entered this slowdown, and so I do expect markets to rally, but I don't think we rally to all-time highs. Like I think we hit those lower highs, and those will be
Hmm.
opportunities to take some profits and shift the money into potentially some of the other areas like consumer staples, utilities, communications, healthcare. Those would be the ones that are more stable through this environment, or add more to the bonds that we own.
Right.
Yep.
Okay. No questions yet. Kind of last call for questions. So what are we looking to for next week then?
Yeah. So one of the things trying my best, I guess, to articulate is, most of the Feds and Bank of Canada's increase rates are already priced into the market. So when we look at the 2-year Canada, it's at 124 right now. And if we look at the 2-year US, it's about 1%. So, you know, I'm getting questions about, well, what happens if they raise rates on Wednesday next week, which doesn't look like they will, but they might. They say, well, what if they raise next week? The answer is they've already priced that in. So unless they're raising 100 basis points next week, the market already knows that. And so, the more likelihood, which what we expect, is they'll raise a couple of times in the first half, and the market's already telling us that they don't want them to raise rates. But if they only raise a couple of times, the bonds that you own should rally in that backdrop, as should the stocks. And so as we think about the construction of the portfolio, the bonds you have today I've already dealt with the rates being priced in. And so that's a positive. And so the expectation is they don't raise as many as is currently priced into the market. And I guess the last thing that people talk about is kind of inverted yield curve, right? So, as the short end comes up, is the long end moving up too, which is what the central bank would like to see. And what the central bank is going to see is that the long end's not moving up, and so you get this flattening yield curve, which again is bad for financials and also a bad signal for the health of the economy. So these are really kind of the things that I look at and continue to pay attention to. But as I say, I'd be shocked if we don't see some kind of rally given this heavily oversold conditions that we're in. We get central banks speaking on Wednesday next week, unless they're super aggressive and they say, we're going to raise 50 basis points. I expect the market to rally around some of the comments that they have. And so that would be an opportunity to further position for quad 4.
Gotcha. Okay. Any parting comments?
I don't. I guess probably the last one is we sent out. We're going to have the annual look back, look ahead on Wednesday next week. So building out the deck for that will be, about an hour presentation. We'll go through some more slides. For the viewers that are here and listen frequently, they'll hear a lot of the things that I've already talked about and seen. But we'll go into more details as I talk about growth and inflation. We'll look at the numbers. Here's what we see. Here's what they look like. Here's why, and delve into kind of more discussion around what we're looking at. Also talk about what happened last year, what worked, what didn't, and what we're doing to get better.
Yeah, so I think everybody got the email on that today, but it's 6 p.m. on the 26th, which is next Wednesday. And we're going to similar format to this, where it'll be live, or we'll send out the recording afterwards as well. So if you can't make it, that's okay too. All right, that's it. Weekend is here.
That's
Get
it.
at it.
Exactly.
All right, everybody, have a great weekend, and we'll see you next week.
Thanks. Take care.